Good morning, everyone. I'm Cess Busby, the editor of Kochie's Business Builders, and I'm thrilled to welcome you to today's masterclass, a small business guide to tax time, streaming live from the beautiful studios at International Towers in Barangaroo, Sydney. But before we dive into our discussion, I'd like to acknowledge the traditional custodians of the land on which we meet today, the Gadigal people of the Eora Nation. We pay our respects to their elders, past, present and emerging, and extend that respect to any Aboriginal and Torres Strait Islander people joining us this morning. Now, tax time, it can be daunting for small business owners, but today we're here to help simplify it for you. Whether you're looking to maximise deductions, navigate changes in tax laws, or simply avoid some common mistakes, the goal of this masterclass is to provide you with practical tips to help you get it right. So, to help us do that, I'm joined by our special guest, Mark Chapman, the Director of Tax Communications at H&R Block. Mark has a wealth of experience in the small business tax space, so I'm very excited that he could join us here today. Mark, thank you so much for being here with us this morning.
It's a great pleasure, thank you.
Excellent, I'm so glad to have you. Now, let's start with some of the questions that I think are probably top of mind for a lot of small business owners. So, number one, what are some of the most common tax deductions that business owners can often overlook?
Yeah, well, the important point is that essentially you can claim a tax deduction for anything, potentially, if it's actually incurred in running a business. So, you know, it depends really what your business actually is as to what you can claim a tax deduction for. But basically, provided the expense is incurred in running the business, provided that the expense isn't disallowed, for example, such as fines or penalties, you know, speeding fines or that kind of
nice
thing. You
try.
can't claim a deduction for that. It is potentially claimable. So that covers basically everything, you know, the costs of employing people, costs of paying benefits to your employees, the costs of renting premises, the costs of writing off bad debts. It's all potentially deductible. But obviously, most of those expenses that I've just mentioned are going to be applicable to most businesses. But if you're in a particularly unusual field, then it might well be that there are some unusual deductions that you can claim. But, you know, provided you bear in mind that there has to be that connection to your income earning capacity or to your business, potentially it's all tax deductible.
So what are some unusual deductions?
Oh, well, I mean, in the individual space, we've had people trying to claim, you know, cosmetic surgery and, you know, for people who are musicians or performing artists, we've had them claim musical instruments or makeup.
But that would be allowed, surely. Instruments.
Well, yeah, absolutely, yes.
Musician.
Cosmetic surgery isn't allowed, unfortunately. Yeah. So that's specifically the ATO takes a very hard line in that respect. So there are lots of instances of, you know, unusual tax deductions in the individual space. In the small business space, not quite so much. They tend to be more straightforward. Yeah. But I mean, there are always things that people forget to claim. Which is why, you know, it's always worth talking to your tax advisor about, you know, what potentially is on the table for your business to actually claim, because you may come up with some ideas that you hadn't previously thought of.
Yeah, would that be kind of the best way to maximise your deductions, would be speak to a professional?
Yes, absolutely, always. So, I mean, about 96% of small businesses do use a tax agent. So, and you'd expect them to be giving that kind of guidance to the business. You know, if you're running a business, you're not a tax expert, you're not an accounting expert. You probably don't have time to devote all of your attention to that side of things. And therefore it is better to basically have a tax agent look after that side of things for you, because, you know, you can then concentrate on running a business and not on monitoring your taxes.
Yeah. So what about your records? Because sometimes, you know, terrible things happen, you get an audit. How long should you be keeping those records, your tax records?
Yeah, well, tax records need to be kept for 5 years from the date the tax return that they relate to was actually due. However, in relation to depreciating assets, that 5-year period runs from the end of the period that you're actually depreciating the asset over. So if you've got a car, for example, which has an effective life of 8 years, therefore you've written the cost off over 8 years, you do actually need to keep them for a further 5 years on top of that. Many people aren't aware of that 5-year period, and therefore it is quite possible that many businesses aren't keeping their records that long. So if they can be educated to keep their records, that is very worthwhile.
So there's been a lot of talk in the last few weeks, the instant asset write-off, the small business energy incentive, all those things only just passed Parliament right before the June 30 deadline. If businesses had installed their assets before June 30, they're okay to claim that now?
Yes. So the instant asset write-off in particular is running for a 2-year period, starting 1st of July 2023 and running until the 30th of June 2025. It was extended in the last budget. So therefore, any acquisition of an asset in that period will qualify for the instant asset write-off, provided that the cost was less than $20,000, and that's per item, that isn't a global figure, and provided also that your turnover is less than $10 million. Obviously, it was looking a little serious with the possibility that might not actually go through, and that could have been a problem if it didn't go through, but ultimately it did, and therefore the instant asset write-off was fully available for last year and also for the current year.
So does that extend to 2025 as well?
To the current year, so from the 1st of July 2024 to the 30th of June 2025, the instant asset write-off is available, yes.
Yes, awesome. So the only thing businesses really need to know is that they meet those thresholds, and that's $20,000 per...
$20,000 per asset, and in addition you need to have a turnover of less than $10 million in order to qualify for the instant asset write-off.
And is there a cap on the assets?
No, you can spend as much as you like. There's no cap, so that's good news for small businesses.
Yeah. Okay. What about probably quite a few of our people that are watching right now actually work from home? So, what are the differences in terms of deductions for them?
Well, if you work from home, there are actually two methods of claiming your running costs. Let's first of all break it down into running costs and operating costs. So running costs are the costs of electricity, the costs of any IT equipment that you buy, the costs of cleaning your home office, all of that stuff. Now, in relation to those costs, you can either claim the actual expenses. Now that means that you do have to have a copy of each invoice for the whole year, which is obviously quite a big task for people to pull together. And in addition, you do need to work out the proportion of the bill that actually does relate to your work, as opposed to the rest of your house, which you might have been using for private purposes. So, all things considered, there's a lot of paperwork involved in that, a lot of calculation. Many people find that a bit too challenging, although it does generally produce a bigger deduction. As an alternative, you can simply claim the ATO's fixed rate, which is 67 cents per hour. You don't need to keep all of the invoices or anything. You simply need to keep a record of all of your hours that you work from home from the 1st of July last year through until the 30th of June this year. And if you do that, you can claim 67 cents per hour. So those are the running costs. Now, if you're running a home-based business, so if your business is actually based in your home,
as opposed to hybrid work.
Yep. You can actually claim a portion of your actual operating costs as well. Those are things like mortgage interest or rent if you're renting somewhere, rates, insurance. All of those sorts of costs of actually owning the home itself. Now, in relation to those costs, again, you do need substantiation, and again, you do need to work out the proportion that relates to your work, as opposed to the amount that relates to private use. However, you can potentially claim those if you're running a home-based business, and that is in addition to the 67 cents or the actual method for claiming running costs. So you could be up for possibly 2 deductions for your operating costs and for your running costs.
And so you mentioned the 67 cents, you just need to keep a record of the days you work from home. What would the ATO consider accurate sort of record? Would it be like your Google Calendar, for example, like documenting your hours? Or?
Yes, possibly. So a copy of any timesheets that you filled out during the course of the year, a diary, rosters, copies of your Google Calendar. Basically anything which shows how many hours that you actually work from home. Or
like your work contract saying you work.
Yes.
A number of days at home or whatever.
Yeah.
And with the running costs, is there a kind of a typical percentage?
Oh no, well it kind of depends on the size of your house and on how much of it you use for work. So there isn't really a standard percentage. That does need to be worked out on an ad hoc basis. So with each individual case, you need to do that calculation.
It's probably don't try and do it yourself, like, 20%.
Yeah, no, unfortunately, it's never that easy.
Also, everyone, if you want to ask questions, we're going to take questions. I can't even talk. We're going to take questions throughout. If you have any questions for Mark, just pop them into the chat and they'll come up to me and I can throw them at Mark. Don't make them too techie because he's just having a chat. He's not actually giving professional advice. So don't come to him with your actual return questions that you need answered. Anyway, so industry-specific deductions, are there those kind of things then?
Well, yes. Basically, whatever your particular industry or profession is, there'll be deductions which are specific to that.
And the ATO has little sheets, don't they, towards, like, I know if you're a journalist, there's like a journalist sheet you can go and look up and it will go, you can make these deductions, these deductions, these deductions.
Yeah, there are lots of those covering all of the most common professions or trades, and quite a few of the less common ones as well. So it is worthwhile having a look at those. In addition, on our own website, on the H&R Block website, there are specific sheets which do much the same thing, but they give guidance as to the specific deductions that you may be able to claim if you're in a particular industry. So yes, you should be able to find reasonable guidance as to what you're entitled to claim from either of those sources. In addition, the ATO does actually keep if you like, a profile of typical taxpayers in an industry, which they use to compare to the actual claims that people actually lodge, so that they can highlight any unusual claims, any large claims. So it is worthwhile just bear in mind that you shouldn't embellish deductions, you shouldn't overclaim deductions, because the ATO, they do have a kind of benchmark for most professions and most industries, and if you do exceed that benchmark, you're kind of setting yourself up for the ATO to come and ask you questions regarding your deductions.
Yeah, and we don't want that. So, earlier we were talking about, the records, the tax records, and how that if you have depreciating assets, etc., you've got to keep them for much longer than the standard 5 years. So in terms of records, like what can business owners be doing that can make it simpler for them to maintain those records and keep them not just like the mad scramble when it gets to June, like, oh, I've got to get my papers together, like to do it throughout the year? What would your suggestions be?
Oh, well, I mean, there are various things that people can do. So first of all, start on the 1st of July. Don't leave it until the end. Don't try to recreate your records, when nearly 12 months has gone by. Make sure that you're actually keeping records as the year goes by. The whole process is actually far less painful if you're setting aside an hour or 2 hours a week. In addition, it could well be worth investing in some decent accounting software to simplify the process. And you might want to consider getting a professional bookkeeper involved who can actually look after your company's books or your business's books through the year. Now, obviously, there's a cost involved with that, but it does mean that responsibility will be taken off you as a business owner, and you'll be able to get on with running your own business rather than worrying about your ATO obligations. And so, therefore, if there is one tip that I can give, it is that it's worthwhile looking at getting a professional bookkeeper to look after your books. It can make things much easier for you.
And that would be a deduction, surely, as well.
Yes.
So it's a win-win.
It is. Yes.
I've got a question that's come through. It's from Diana, and she's asking, if you have a new business and haven't made any income yet, do you still need to lodge a tax return? And can you keep your deductions until a time when you do have income?
Yes, you do need to keep. You do need to lodge a tax return. So if you're running a business, you need to lodge a tax return every year, regardless of whether you're making a profit or a loss. In terms of whether you're making a loss, so in other words, in a situation where your deductions exceed your income, normally those business losses can be offset against any other income which you have during the course of the year.
Personal income?
Yes.
Yeah.
Well, that depends on the business structure. So if you're a sole trader, yes, it can be used against your business income, your personal income rather. If you're a company, however, the losses are effectively, they're quarantined to the company. So they're simply carried forward and they're used whenever ultimately the company does make a profit. However, in relation to individuals who are running a business as a sole trader, it is worthwhile pointing out that there are some specific rules which are called the non-commercial loss rules, which I won't go into in enormous detail, but you do need to make sure that you pass certain tests to prove to the ATO that you are actually running the business as a business, as a genuine business, with a view to making a profit. And if you don't pass those tests, once again, the loss is effectively quarantined. It can only be used against the business's future profits. It can't be used against your other sources of income. So just beware of those tests. Speak to your accountant to understand them, because it's quite complicated.
Yeah, because haven't there some new rules coming in terms of income that you need to say you're a sole trader, but you get most of your income from one client, then the ATO could see you as not actually being in business, but being in personal service. They're not. Yes.
The personal services rules are worth pointing out as well. They're in addition to the rules that I just mentioned, which possibly prevent the use of losses. There are also the personal services rules. They've been around for a long time, but basically, they are looking particularly at contractors. Doctors, people in the accounting profession, architects, people in those sorts of professions who the ATO is trying to prove that in actual fact they're not actually in a contractual relationship with a particular business. They're actually in effect almost employees of the business. And if you fall foul of the personal services income rules, then the amount that you get paid is effectively taxed as a salary, and PAYG does need to be deducted and paid. So that's another thing to be aware of. If you are in a professional type business, it is worthwhile getting your head or getting a tax agent to get around to understand the personal services rules. They are very complicated. We could be here all for the remainder of this session if I was going to go into it in more detail. But it is worthwhile just bearing those rules in mind.
Yeah. Okay, we've got another question. This is from Alex, and Alex says, I have a fairly common scenario for professional service providers as a sole trader or sole director and sole employee of my own company. I operate from home and visit/work from my client's office in the city 2 days per week. Would that scenario be eligible for the operating cost deductions that you mentioned?
So this is somebody who has a business which is based from home, is that correct?
Yeah, so she's a sole trader and the sole director of that company.
Yeah.
She works from home, but she also works from a client's office 2 days a week.
Yeah. Well, yes, if the client, if this person does actually have a home-based business, they are potentially going to be eligible for their operating costs. However, I would just bear in mind the personal services income rules, which we just mentioned. If they are applicable, I don't know whether they are, if they're applicable, actually the individual would not be able to claim the operating costs. So it is worthwhile checking that. It is worthwhile very much talking to a tax advisor in that kind of situation.
Now, going back to those records and being more organised, you did mention a bookkeeper, but are there any apps that you think are useful for small businesses in terms of making sure that they get better accuracy with their records?
Yeah, well, there are. I mean, the ATO has a My Deductions app where you can store all of your expenses. That's particularly going to be relevant for individuals. H&R Block has something similar. Beyond that, you're really looking at paid packages, which are
like for receipt capture.
Which are more appropriate for small businesses. So, as you said, receipt capture, Xero, etc. All of those accounting packages are worthwhile looking into because they do enable you to keep track of your expenses during the course of the year. They also enable you to keep track of your income during the year. So you're getting a full picture of your business's performance as you go through the year, rather than just waiting until the end of the year.
Got another question from Alex. She's asking, regarding bookkeeping, what penalties can a small business face by failing to lodge their monthly or quarterly BAS? Whoa.
Oh, well.
Ones I don't want to think about.
So this business has possibly failed to lodge their BAS. Look, the penalties for failing to lodge a return start well. If the return is lodged up to 28 days after the due date, there's a penalty which is equivalent to one penalty unit, which is basically in dollar terms, I think about $370, I think, something like that. For each 28 days that the form is lodged late.
Escalates?
Yes, it escalates. And that can go on for ultimately 5 periods. So ultimately the maximum penalty is 5 times that is about $1,200, $1,300, something like that. If you're still not lodged, then the ATO can use other means to get the return from you. They can, they can prosecute you. They can issue a default assessment if we're talking about an income tax return. There are various ways that the ATO can get the missing document from you, but hopefully it wouldn't come to that. But yes, there is going to be a financial penalty in the first instance if somebody hasn't lodged their BAS. And
worse penalties as it goes on if you fail to pay the taxman or lodge your papers. So apart from people not lodging things on time, what are some common pitfalls that you're seeing small business owners?
Yeah, well, I mean, a lot of small business owners, particularly ones who are new into business, have started a business, and the temptation is to, you start running a business, and then a year down the track, you suddenly become aware that you've got tax obligations, potential tax liabilities, and you become aware that you haven't actually saved the money to pay them. So I think basically it is worthwhile making sure that you first of all monitor your cash flow, and secondly do make sure that you are accounting for tax on a regular basis, that you're putting some money aside towards your ultimate tax bill. So, I mean, you might well end up having to pay instalments anyway, but either way, you do need to be aware that you do need to set aside something to settle a tax bill, either quarterly or yearly. Don't go out and spend whatever you've made from the business, because ultimately the taxman will want at least 25%, probably more if you're a sole trader, and that can come as a big shock, particularly if you're relatively new into business, particularly if you come from an employment background where tax was being deducted from your wages automatically.
You didn't see it, so.
Yeah. It's very easy to forget about the taxman when you're actually starting in business. So, don't do that. Many small businesses do fail within the first 3 years, and that's a large part of the reason. Businesses which don't take account of their cash flow, they don't measure the cash flow. So it is worthwhile keeping an eye on your cash flow, making sure you've always got some money to pay the taxman.
Got some more questions. This one is from SS. SS asks, as a sole trader, what kind of items are pre-tax deductions, as in to reduce income, versus post-tax deductions, that is deductible after the total income is decided?
Right, interesting one. So, well, if you're a business and you're spending money, then that will be deducted from your the income that you actually earned. Mm-hmm. That's just the way it is. So I'm not quite sure how that fits into the overall question, but basically the rule is that you earn income, and from that you can deduct any tax deductible expenses, and therefore you end up with a net profit.
Well, maybe she's meaning things like reducing your income, maybe salary sacrificing or that kind of thing to your super. Would that be a way to...
Right, so is this
like pre-tax deduction?
Yeah, so is this somebody who's possibly employed?
I don't know. She said she's a sole trader, so I don't know if she's a sole trader as in someone who's got a side hustle and is thinking about how to reduce. SS, a bit more information and maybe we can give you a clearer
Because for somebody who
response.
is employed by somebody, yes, absolutely. You can salary sacrifice. You can salary sacrifice into a novated lease for a car, for a company car, effectively. You can salary sacrifice super. You can salary sacrifice. Yeah, exactly. Yeah. All of those things, but that is very much targeted at employees, not actual business owners.
Yeah. Leanne asks, if I have a PTYT Ltd. And I want to take director's drawings or a lump sum, do I need to pay super on those or PAYG tax or both?
So this is a director?
Yes.
Yes.
She has proprietary limited company. she wants to take director's drawings or a lump sum payment, does she need to pay super on that?
Well,
Or
that's
tax, PAYG tax?
That's potentially quite a complex question, because the question is a director an employee? And that comes down to the specific facts
Way
and the
it was
circumstances.
structured when you set it up.
I mean, probably if she is the sole director, the chances are that she would be regarded as an employee, because she would actually be working in that business effectively as an employee, and therefore any payments that she receives, they would be liable to PAYG and superannuation, but that isn't necessarily the case. I mean, generally speaking, directors aren't actually employed by their business, they're regarded as self-employed, but it does depend on the specific circumstances.
Yeah, how the company was set up in the
Yeah.
first place. Okay, so every year the tax department targets particular areas. What are they scrutinising this year?
Oh, well, various things. So, as in previous years, they're really focusing on work-related expenses. So the ATO believes that there's about an $8.2 billion tax gap, which is the difference between the amount of tax which the ATO expects should be paid and the amount of tax which actually is paid. So that's in relation to individuals, and the ATO believes that by far the largest contributor to that tax gap is people basically overclaiming expenses or claiming expenses that they're not entitled to claim for their work. So the ATO is really looking at, for example, working from home expenses. I mentioned with the 67% rate, you've got to keep a record of all of your hours during the course of the year. So the ATO is going to be checking that people have actually done that. Claiming car expenses, claiming the 85 cent per kilometre car expenses, which you can claim for up to 5,000 kilometres. So the ATO is going to want proof that you have actually done, well, not so much a logbook, because you don't need a logbook with the cents per kilometre method. But you do need to have kept some sort of record of your journeys, and you need to be able to prove that you did actually do the kilometres that you've claimed, because the ATO thinks that there are people who are simply claiming the full 5,000 kilometres and actually they haven't done anything. So that's a real focus area. In terms of small businesses, the sharing economy is very much a focus area, because the ATO believes that many people simply don't understand the tax obligations in the sharing economy. They don't necessarily understand that they are in business. They might think that somebody's an Uber driver as a hobby. That's the perception that many Uber drivers have. So it is. The ATO is really looking at the sharing economy, at ride sharing, people who are working through Airtasker, Airbnb, etc. There's lots of non-compliance in respect of those sharing economy businesses, and so the ATO really has a focus on those. So if you do have sharing economy income, it is well worthwhile making sure that you are declaring that to the taxman.
Because it all gets sent to them anyway, doesn't it?
Well, yeah, that's the thing. The ATO gets information from the sharing economy platforms, so they know exactly who is within the sharing economy, and they know exactly how much they're earning, and therefore they can use that to match to people's tax returns. And if they don't match, you get pinged, and you can expect a please explain letter.
Yeah, you don't want a please explain. So, also there's been some recent news about, how contractors are being reclassified as employees recently. What kind of changes does that mean for small business owners?
Oh, well, if you're a small business owner and you do have contractors on your books, it is worthwhile pointing out that ultimately the tax liabilities in relation to those do actually lie with the small business rather than with the contractor. So in other words, if a small business has actually engaged somebody as a contractor, Whereas in reality, that contractor might well be an employee. The actual tax burden falls on the small business, not on the contractor. So, if you're employing a worker, you've got to pay PAYG, you've got to pay super, you've got to pay FBT on any benefits. You've potentially exposure to work cover, annual leave, sick leave, the various types of leave. So they're all potential liabilities for an employee. For a contractor, on the other hand, there's no PAYG. In effect, the contractor is getting paid as another business, and the contractor themselves have to account for tax on that. So therefore, the business which is paying them, yes, the business which is paying them doesn't have to worry about tax. They possibly don't have to worry about super. But that's a grey area, because if the contractor's providing their services, their labour, to the contracting business, then they could be caught by a specific piece of superannuation legislation which expands the definition of employee to include...
Isn't it a number of hours or something per month? Or
No, it's basically if the services are principally for labour. Now, so you need to look at each individual facts and circumstances, but in those circumstances, there might well be superannuation payable for them, because they do meet the definition of the extended definition of an employee. So it isn't necessarily the case that you don't have to pay superannuation to a contractor. You may well have to. There's no FBT if somebody's a contractor. In addition, if the contractor has GST liabilities, then the contracting business will be able to claim an input tax credit. However, it is important that the business does actually make the right choice, whether it's an employee or a contractor. Because if the ATO comes along and looks at a particular contractor's arrangements and decides that actually that contractor is really an employee, that falls back on the business, and they ultimately become liable for the PAYG, which hasn't been paid. That can potentially ultimately become a personal liability of the director of the business. And in addition, they become liable for superannuation guarantee charge, which is very expensive. I think it's twice the amount of superannuation that would have been payable, plus interest, plus an administrative fee. So therefore, you're looking at very big dollars if a business makes the wrong decision. So it is essential that you do employ somebody or contract with somebody in the right way, and that somebody is actually an employee or a contractor in a genuine sense.
We've got some more questions that have come through. Caroline's asking, are the ATO auditing the people who do their own tax return and claim the 5,000 kilometres? I'd say it's pretty blanket.
Yeah, I think it is pretty blanket. The ATO is auditing basically everybody that is, that has risk flags, whether they are lodging via MyTax or whether they're lodging via a tax agent.
If they claim the maximum deduction for something.
Well, I mean, that can be fine if somebody's claiming 5,000 kilometres at 85 cents per kilometre. That's okay. Provided it appears obvious that that person will be travelling for work. If it looks like their occupation will require them to travel for work. I mean, the ones that the ATO is looking for are people who are claiming all of those kilometres, but actually the chances are that they're not actually doing any work-related travel in the first place. Yeah. They're simply based at one place, and the only journeys that they're doing are the commute to and from their workplace, which aren't tax deductible.
And that's not tax deductible anyway.
No.
Yeah.
So that's the kind of situation that the ATO is looking for with those.
So what is an actual a work travel expense?
Oh, well, travel between two workplaces is generally tax deductible. Travel from home to a workplace generally isn't tax deductible, so it's generally regarded as a commute, and it's private in nature. However, there are all sorts of little twists to that. So if, for example, you work in one location, the journey to that one location won't be tax deductible. But if you get seconded to another location and you have to drive to that location, that could well be tax deductible. That's where it's useful to get a tax advisor or a tax agent to look at your affairs, because the definition of work-related travel is quite complex, and that can easily trip you up or potentially give you an additional tax deduction, depending on the circumstances.
Now, SS has come back with a bit more information. They say, thanks for exploring my question. To clarify a little, I have a contract with a couple of organisations and business elements that are non-contracted. I have allowed for super, GST, tax, HEX, Medicare, etc. in my billing. Which of these are pre and post income deductions?
Goodness me, I think that's rather a complicated question. I think I would want to take that one on notice rather than commit to giving advice on that.
Yeah, it might be one for you to actually speak to your accountant about, because it does sound pretty complex. Sorry about that, SS. All right, we've only got time for like one or two more questions. So let's see. What are some red flags that would trigger an audit for a small business?
Oh, well, I mentioned the ATO benchmarks. I mean, in relation to small businesses, the ATO also keeps benchmarks. So, they build up a profile of what certain types of businesses should be expecting in terms of profitability, in terms of what deductions they should be claiming. So therefore, if your business is in that kind of field and you're claiming outside those benchmarks, so you're claiming excessive deductions or you're claiming excessively low turnover, that would probably trigger a risk flag and could well lead to an ATO investigation. So, to give an example, a few years ago, the ATO was looking at coffee shops, in particular coffee shops. And they were investigating a particular coffee shop which had recorded relatively low turnover. And they'd actually got information from the coffee supplier as to how much coffee they had actually supplied to that coffee shop. And from that, they were able to work out roughly what the turnover should have been. And obviously there's a big discrepancy between what the turnover should have been and what it actually was. And therefore they got audited. So that's the kind of example of the ATO, the tactics used by the ATO.
And that's probably a business also which at the time a few years ago would have dealt with a lot of cash.
Yes. Yeah. Yes, I mean the ATO still has a real focus around cash businesses. There aren't as many of them these days, but I mean you do still find particularly tradies who do like to deal in cash, which generally attracts the ATO's attention for obvious reasons.
I'm afraid I can't believe it, but that's all we've got time for, and I had so many more questions for you. Thank you so much for joining us today, Mark. It's been great having you, and I'm sure our viewers have really gained some great insight into tax time from what you've said. So if you'd like more of the latest small business tips and practical advice, then head to our website, koshesbusinessbuilders.com.au, and be sure to tune in for our next masterclass on August 21 with Justine McLean, where we'll be unpacking a small business guide to money matters in 2024. See you next time.